We're going to focus on the ins and outs of group insurance in this presentation. Please do check out the previous intro to group insurance presentation before watching this one. There is some information in there that you do need to know before this presentation. Now, we do cover a lot of different sections from Chapter 6 in this presentation. So if you are looking for additional information, please do check out Chapter 6. Anywhere past 6.2 will be covered in this presentation. So we're going to start off with term coverage and sort of what members get when they are part of a group plan. So all members have a set base coverage, and that's provided to them with no evidence of insurability. That base coverage is annually renewable, and they do get it every single year, that same base amount of coverage. So whether it's $25K or whether it's $30K, it just depends on the contract. The group members can also purchase additional insurance, and typically with additional insurance, you do need to provide some evidence of insurability. And this is because generally high-risk members will apply for more coverage, while low-risk members are less likely to apply for coverage because they're not as concerned about the possibility of qualifying for coverage. Now, there are some insurers that will waive evidence of insurability for additional insurance, but that's as long as you're signing up for that additional insurance within a certain period of time. And that period of time is usually that enrollment period. The additional insurance is sold in units, for example, $25,000, and that might also be extended to the dependent or to the spouse of the member, so they can bump up their dependent coverage as well. Now, this additional coverage is usually term. It almost never is permanent. I wouldn't even think that it ever would be, so that's something to keep in mind. The benefits can be a little bit different, and the amount of the base coverage can change based on how the plan is set up. And there are a few different ways that the plan can be set up. The first is earnings multiple, and that is kind of self-explanatory. It's a multiple of the member salary. So for example, it could be 2 times the annual salary. So if you're earning $50K, then your coverage, if it's 2 times, would be $100. The flat rate it's always the same for every member. So that base amount, regardless of your position in the company, is always the same. So maybe everybody gets $25,000 no matter what. Length of service is based on how long somebody's been with a company. And this is really an incentive for people to stay with the company. It's a reward for long-term employees or long-term members of the plan that they get more because they've been part of the plan for longer. And the last is the combination. It could be a combo of any of the above methods. And again, this will be clearly defined in the contract with the policyholder. There can also be a max coverage amount for older or retired members or for all members. So just something to keep in mind when you're talking to your clients about their coverage and how much coverage they can get. The dependent coverage we mentioned what a dependent is before, but I'll quickly go through it again. A spouse, common law spouse, unmarried children, 14 days to a max age, and if they're in school, possibly a little bit longer. Now, the dependent coverage is optional and it's paid by the member. You do need to add your dependents within a certain period of joining others in order for the evidence of insurability to be waived. Now, it is completely up to the insurer, so it's possible they might still require evidence of insurability. They might not, based on the time frame that the members' dependents are joining. And the premium does remain the same for each dependent. There are also survivor income benefits. This is an optional benefit, and it's income for the dependent survivor. So if the member passes away, it will be income for that surviving dependent. And it's based on the member's income. It's usually a percentage of their income. And for a spouse, it will continue until age 65 when they remarry or when they die. For children, there's usually some sort of a maximum age. So perhaps it could be age 21. And it is possible that if the child is orphaned as a result of the member death, then they might receive an additional survivor income benefit or more survivor income benefits than somebody who is not. The accidental death and dismemberment benefit might be included, it might not be, it's optional, and it's actually considered a voluntary benefit. Now, the things to remember about this is it doesn't cover anything that's self-inflicted, criminal act of war, murder, piloting a non-commercial plane, so drunk driving, drug overdose, all of these things are not included because they're not considered to be an accident. So that's really something important to remember. It only comes into play, it only works if there is an actual accident happening or happened. The conversion privilege. So being a member of a group plan allows you the privilege of converting into a permanent policy or into another policy. And there are some specific situations that the member has access to this. They either leave the group, so they quit, they get fired, or they're for some reason no longer a member of the organization. The group terminates, or the group switches insurance providers, which does happen. Groups often switch insurance providers in order to get lower costs, and it might affect coverage for if somebody's class doesn't exist anymore, isn't included when they switch to a new insurance provider. And so in that situation, those members also have the ability to convert, and they can get the amount of coverage up to the maximum of the replacement coverage, so the same coverage that they originally had, and that's based on the CHIL guidelines. So Quebec, to start off with, Quebec has some specific guidelines about conversion. The option to convert all the coverage before age 65 without evidence of insurability. The member has 31 days after leaving the group, and during that time, the coverage actually does stay in place for those 31 days, so they are still covered under the insurance policy. They can convert anywhere between 10K to 400K of the contract, and they must have at least $5,000 of dependent coverage. When the master contract is terminated, the members are allowed to convert whichever's greater, $10,000 or 25% of their coverage. The rest of Canada follows the CHIL guidelines, and this means that they are allowed to convert up to $200,000 without evidence of insurability. YRT is as a minimum, and it's up to a maximum age that they have this conversion privilege, usually something around 65. And now the dependent coverage is not included in the guidelines, so it is based on whatever the company chooses to do. So conversion premiums, it's important to remember that they can be more expensive, and they typically are more expensive than applying for a brand new policy. And this is because a brand new policy requires evidence of insurability, and so you're proving that you're not risky. Whereas when you're converting, you are not providing that proof, and so the insurer is taking on more risks and therefore charges for that additional risk. It is possible that you can apply for an external policy, and if you do qualify with providing evidence of insurability, you do get approved, then you can cancel your policy, your group policy, if you decided to convert it. So that would be a way that you could sort of help your clients save some money. Group creditor insurance. Now, this is provided by banks or lenders, and it's usually offered when a client has a loan or a mortgage, some sort of debt that they've taken out with a financial institution. The premiums, when a client does opt into this, the premiums are added to the loan payments, and it's based on an age range per 100,000. So, for example, 25 to 35 get the same price per $100,000 of insurance. 35 to 40 get the same price, etc. And the death benefit is equal to the debt, and it declines over time. So if you have a debt of $100,000, your death benefit will be $100,000. And as you pay off your debt, the death benefit decreases as well in step with that. The death benefit pays that debt to to the financial institution if the borrower dies. So the financial institution is the beneficiary in this situation. There are some optional extras that allow you, or that are offered when you do have group creditor insurance. They include disability, which would cover your premiums for your loan. So it would cover whatever your loan payments are. Critical illness, so that would pay a lump sum towards the debt, so you wouldn't have that debt anymore. And unemployment, again, covers the premiums for the loan. So these are specific when offered by group creditor insurance to the loan, and they're always related back to that amount of money. Now, there are CLHIA guidelines for group creditor insurance. And it's important that your clients know this because there can be a lot of miscommunication in this area. The insurance provided is optional from the creditor, so the client can decline it. They have 20 days to change their mind, and they can also cancel it at any time. They are not required to get this insurance. They could be required to get some sort of insurance, but it does not have to be through the creditor. The premiums and the terms and exclusions have to be disclosed to the client, and this is subject to approval. So sometimes they do have to provide financial or medical evidence. And in that situation, if there is a decline, the client must be informed so they're aware they're no longer being covered. And that is everything for group coverage. If you would like some more information, again, check out Chapter 6. Anywhere from 6.2 to 6.9 is what we've covered in this presentation.